Knowing your risk. But standard deviation, the higher the standard deviation, the higher the volatility, and then the beta, the higher the beta, the higher the number, the higher the risk. And again, you can pick, and it's Scott's job and my job to guide you through and see what's appropriate for you. We don't want you to get greedy and chase a hot, if we're in we got aggressive portfolios that can do very, very well. And all of a sudden they have a 30% year, and then people start to want that. But then they forget that it can go down 40%. So you can choose, you can choose the baby roller coaster or the medium roller coaster or the beast, one or the other. But you have to choose one that you can stay disciplined with. That's important. So here's a quick video on beta, so you hear it from someone else other than me.
Beta is a historical measure of the risk an investor is exposed to by holding a particular stock or portfolio as compared to the market as a whole. The beta of a share in Casey's Corn Company is 0.5. This means that Casey's has historically been 50% less volatile than the market. So if the market moves up by 10%, Casey's stock will only appreciate 5%. If the market declines by 2%, Casey's corn will lose only 1% of its value. The change in market value is multiplied by a stock's beta to estimate its movement. The risk and reward trade-off suggests that high beta stocks have a greater risk and, as a result, a higher expected return. If Casey's has a beta of 1.5, it will theoretically be 50% more volatile than the market. This means it is likely to gain 15% when the market gains 10% and lose 3% when the market drops 2%. A stock with a beta of 1 would move in tandem with the wider market. Both low and high beta stocks have their place in a portfolio. Low beta stocks are stable. Their performance is weaker than the market as a whole when the stock market is strong, but when the markets drop, these stocks usually experience less dramatic declines. High beta stocks are the opposite. They outperform when the market's strong and fall further when the market declines. However, it is important to remember that beta is a historical measurement, so it can't predict the future. The beta of a stock will change as more historical data points are added, and many such events will prove to be entirely unpredictable. Beta is a useful measure for investors because it helps them create portfolios that match their risk tolerance.
Okay, did you catch that beta is historical? Okay, that's important. They're a little bit more accurate with broadly diversified portfolios than they are with individual stocks. You can still get a beta and a standard deviation from an individual stock. But like I said before, you can wake up any morning and that stock could be soaring or it could be crashing for all kinds of unknown reasons that aren't factored in a historical beta. And that's less likely to happen in a broadly diversified portfolio. Same thing with standard deviation, very similar, that this is the volatility.
Standard deviation, or variance, is a measure applied to the annual rate of return of an investment to measure the investment's volatility. Every time you buy a stock or a mutual fund, you're weighing its expected return against its inherent risk. The past gains or losses of an investment are fairly easy to look up, but gauging risk is a little trickier. Applying the standard deviation formula will show how much an investment's price has gone up or down in the past, and therefore helps in evaluating future outcomes. Take, for example, a security where we analyze 5 periods of the following stock returns: 2% in January, 7.5% in February, 1% in the next month, 6%, and 1.5% finally in May. To find a standard deviation for a security, find the average historical return, which is 3.6%, and subtract the returns from each month. Square them, and find the sum. Next, we divide that sum by the number of observations minus 1. In this case, it would be 4, leaving us with the result of 8.675. Taking the square root of that number, we are left with a standard deviation of 2.9. The calculation can be particularly helpful when looking at similar investments in the same asset class. If one investment has a higher standard deviation than the other, that investment is more volatile. Note that past volatility or lack thereof doesn't perfectly predict future returns. A stock that has been consistent for months or even years may suddenly experience sharp fluctuations.
So you guys wrote down that formula, right? So you can figure all that out? I didn't see anybody writing. So luckily, these guys do these calculations for us, and we can look it up for each individual investment. So if you know your risk measurements, you know what to expect, and you won't be caught off guard when downside volatility occurs. What happens is people get into these highly volatile investments because they made a lot of money, and all of a sudden something in the market drives the price down, and then they sell and get out. Volatility is okay though, because if you eliminate the volatility, you eliminate the additional potential returns. So we got to have some volatility. So CGM Focus Fund is a fund that we show people on occasions because it's a pretty glaring example. You saw a beta of 1 equals the risk of the market. This has a beta of 1.52 and a standard deviation of 27.94. You'll see that's way higher than most of our portfolios. But what investors saw one year is it made 79%. So guess which was the popular fund the next year? They piled right into it. But look what happened the next year, minus 48. And then it lost, in 2011, lost another 26%. Bottom line is, don't be tempted to take on more volatility than you can handle. You've got to be able to stick with it.